It's called SanDisk, and they make these memory cards. And in US dollars, that company was up for the first quarter alone over 150%.
If you did not have an exposure to the Magnificent Seven, then you would underperform in your portfolio.
And not only that small outperforms large, but also value beats growth. And when you look at the US stock market in January, the S&P 500 was up about 1.5%.
So what was some of your comfort or wisdom you said to that family who might still be feeling very uncertain?
These 7 companies were down about 11.3%.
But if you actually want to make money, if you really want to be a successful investor, you have to follow the rules, right? Which is...
Welcome to another episode of the Purposeful Investor podcast. We're a podcast for successful families who want to make smart decisions with their money and avoid costly mistakes. We're here so that you and the people you care about are going to be okay no matter what. And we're also here to set you up to live a great life. Thanks for joining us on another episode of the Purposeful Investor podcast. Joining me in the studio today, we've got David Andrew, the founder of Capital Partners. David, welcome to the podcast.
Thanks, Aden.
And dialing in from the other side of the world, all the way in California, we've got Apollo Lupescu from Dimensional Fund Advisors. Apollo, welcome to the podcast.
Gentlemen, thank you so much for the invitation. It's great fun to talk to you again.
So today we thought we'd take the opportunity to almost come up for air a little bit. We're looking at the first quarter of the 2026 calendar year, and there's been a lot that's been going on in financial markets, the share market, and the world as a whole. So we want to just sort of recap what's happened and almost step back and look at all the events and what that's actually meant for share markets and the broader world. But as our listeners know, before we get into the content of the podcast, we like to start off with our little win of the week. So that's anything you can reflect back on in the past week that's been a little win either in your personal or your professional life. So Apollo, why don't you start us off with your little win today?
My little win of the week is really about being able to connect with a family who worked with an advisor. And over the past a few months, they have been really anxious about what is going on. And I was fortunate enough to be invited to meet with that family. And we spent maybe about 2.5 hours. And at the end, I could see that between, our comments, my advisor and mine, there's just almost like a weight being lifted off the shoulder of that family once they understood a little bit better what's going on and how they're invested. And to me, it was an amazing feeling to be able to educate somebody and very, very promptly being able to see the impact that it can have on a family. So to me, it was a big win. Just feeling that sense of relief that the family had once they understood a little bit better what their investments are all about.
Definitely. I imagine there's lots of people probably feeling similar ways at the moment. So nice that you can have that impact with someone who's feeling that way. What about you, Dave? What was your little win?
Yeah, well, we just had a long weekend here in Perth, and it was to celebrate Anzac Day. So Apollo, Anzac Day is effectively our Remembrance Day, when we remember the Australian and New Zealand troops that landed on Gallipoli in 1915, and then all the sacrifice that's happened since. And Australians take it very seriously. And I just always love the day, and I love reflecting on, I guess, the solemnity, the way we just pause and acknowledge and remember those people. So yeah, super cool. Also happened to be my second son's 30th birthday. So we had a little bit of solemnity and a little bit of celebration all at once. So that was kind of nice.
Nice, a nice balance.
Yeah. And you?
So mine was a personal win as well. So just a really little one, but just sorting a few things out around my place. So got a few prints that I'd bought, put them up they're all up on the wall, set up the wine rack, a few little pots. So just all those little sort of house or life admin things that you sort of get the opportunity to do on a long weekend. So
do you need some donations for the wine rack?
Oh, I'll never say no to that.
I can help you with that.
So let's dive into the content. So as I alluded to, there's been a lot that's been going on in the world, and we're sort of recapping what's happened in the first quarter. But I thought it might be useful to actually look back and say, since January, the start of the year, what are the really big events that have happened? Because there's been so many that it's almost hard to keep track of. So why don't we start with that?
Yeah, well, I don't know about you, Apollo, but I know the world's a crazy place, and I know that there's always a lot of stuff going on, but I was just looking up a slide. January, the US military captures President Maduro of Venezuela. Then President Trump on the 9th decides he really does want to acquire Greenland. And then we fast forward, there's a government shutdown at the end of January, and then the government shutdown ends, and then the Supreme Court rules that the president's tariffs are illegal, and then the president on the 20th immediately bounces back and says, no, we've found a new way to do this. There's going to be a blanket 15% tariff. And then the mother of all events, on the 28th of February, the US and Israel launched coordinated military strikes. And that's been the narrative for all the way through to the end of the quarter in March and ongoing. And it kind of strikes me that the story you told about your little win, that family that you got to meet with, were understandably rattled. You're talking to advisors and investors all over the world all of the time. I imagine this is one of the most unsettling periods you've seen in quite a while, Apollo.
For sure. I mean, it is not only unsettling because of all these economic events, but something that I think we touched on a while ago, which is this idea that before we go to numbers and data and economics and money, we have to acknowledge the human element. There's a lot of suffering that is going on at the moment in the world, and there are troops, and I know families. That particular family was also anxious because they had a family member deployed, and you also have all these folks that you see images of rubbles and buildings and children hurting and all that, and that's really impactful. And those images, at least for me and for people, they trigger some emotions. And I think what's been so interesting is that the emotional impact that these events have had on our psyche. And quite often, I think that what a lot of people tend to do is associate these emotions to something that they see as obvious outcomes in the market. And what we found over and over and over again, and as part of the conversation that we had with that family, is it is really important to acknowledge these emotions because they're real. That's what makes us human. And at the same time, professional investors and managers and advisors like you are able to acknowledge these events and at the same time disentangle them from investment decisions and make sure that whatever decisions we make about our money, they're based on much more pragmatic reasons. So when you look at data, I think that's one of the ways that we found it's really powerful. We can go back, as you said, to January, and last year, both in the Australian market, the U.S. market, global markets, it actually did really, really well. The Australian market did tremendously well. The U.S. market did well. And when you look at the U.S. stock market in January, the S&P 500 was up about 1.5%, which is a nice result. It did move up. And February was followed by a negative month. So by the end of February, there was not much. I mean, the market was pretty flat, not much going on if you just look at the data. And then at the very end, that's when we had the bombing of Tehran and the military action with Israel and the United States. And what's interesting is that's when you saw the S&P 500 dip. And for the month of March, it was a negative 5%. And I think what's really fascinating is that when you look at the entire quarter for the first 3 months of 2026 in the U.S. market, we saw a downturn of about 4.3%. And there are some things that I want to just kind of touch on for just 1 second, David, is that when you look at that 4.3%, the first thing to know, which is so interesting, is that if you rewind the tape exactly 1 year, to the first quarter of 2025 in the U.S. stock market, in U.S. dollars, what you see is that the performance of the market was identical, negative 4.3%. And then second quarter was positive, despite the tariffs and all the nuttiness. Third quarter was positive, fourth quarter and positive, and really the S&P ended up very, very nicely for 2025. So just because we had this negative quarter, folks, don't read too much into it because it doesn't mean as much as you think. It's really just something that we've seen before, and the fact that the market dropped the first quarter says nothing about what's going to happen the rest of the year. The second thing to point out is that when you look at the performance of any market, including the US stock market, including the Australian market, not every company goes up or down. And for the first quarter, what's fascinating is that you had about 53% of all companies, the stocks in the S&P 500, dropping in value. And that is called a negative return. You lost money on those companies, on those stocks. And what's also interesting is that roughly half, 47%, went up in value, and you made money on them. So not every stock went down, not every stock went up. And it's interesting to see which ones might have gone up or down. Because, for example, if you look at a company who did the best in the US stock market for the first quarter, it turns out that if you are a fan of photography, you might recognize this company. It's called SanDisk, and they make these memory cards. And in US dollars, that company was up for the first quarter alone over 150%. Over 150%. Dow Chemicals up about 80%. Moderna, the vaccine maker, 70%. You had the energy companies up over 30%. So as a swath of sectors, it wasn't limited to just energy. And in fact, a lot of other companies did quite well. And it's also fascinating because on the lower end, you had companies like Estee Lauder, the cosmetics company, down about 30%. You had other companies like Paramount, which is the entertainment company, down about 30%. Workday, which is a software company, and DoorDash and so forth. So it wasn't necessarily clean that, oh, these companies made money, these did not make money. But the third point that I want to make is also very important, is that when we measure the market performance, in this case, negative 4.3 for the first 6 months, when we think about the market, is not just the individual result of every company, but the way we arrived from 500 different individual numbers to a single number is also by taking account of the size of the company, of the stock. And in that respect, the largest stocks in the market, based on their ownership value, they receive a greater emphasis on their performance. And this is where it gets so interesting, because these magnificent seven that you've heard so much about, and that's NVIDIA, that's Microsoft, that's Facebook, Amazon, Google, Tesla, and Apple, these seven companies are important not only because they have technology and AI, but they're some of the largest in the US stock market, and in the global markets for that matter. And what's fascinating is that if you take these seven companies aside, again, keeping in mind that the S&P was down about 4.3%, what's interesting is that these seven companies were down about 11.3%. Significantly more than the market as a whole. And what's so remarkable is that the remaining stocks, because they left a hole in the S&P. So if you look at the S&P 500 minus these seven, let's call the S&P 493, it was pretty much flat. It was pretty much flat. So, if you're trying to attribute and try to explain why the market went down, it's tempting to say, well, the war was bad for the market. Well, it turns out that the market for the quarter was pretty flat. It is that these seven stocks dragged it down significantly from almost even to a negative 4.3%. And I'm not sure that I would associate all these stocks with the Strait of Hormuz and oil. I don't know about Facebook or Google or NVIDIA. But they did have that impact, that significant impact, because among the seven of them, these stocks amount to roughly about 32% of the value of the entire S&P. Meaning that about a third of the performance of the S&P is driven by these seven stocks. So they have a tremendous impact on the market results as a whole. And the same exact seven stocks are also part of NASDAQ at 51%, so significantly more. And if you have a global allocation that includes US, Australia, New Zealand, Japan, and so forth, at that point, you're still going to own these, but in a smaller percentage. You take away that concentration risk, and it's only about 18%. And that's why you saw that among these metrics, NASDAQ did the worst, being the most heavily concentrated. S&P was in the middle, and the best performing among the three was the global allocation. So I really wanted to emphasize these 3 points when you look at performance. It is something that we've seen in the past. Just because the first quarter is negative doesn't mean much. Look at last year. Secondly, we had a variety of returns, positive and negative. And then thirdly is that these Magnificent Seven are really impactful to the market because of the high percentage they are in the U.S. and even globally. 18%. It's still a significant portion.
The Magnificent Seven for the quarter to the end of March 31st. The falls in those 7 companies represented $2.4 trillion. So the people who have been scrambling to get exposure to the Magnificent Seven, thinking, okay, this is my silver bullet, they're kind of hurting right now, which is a fabulous advertisement, I guess, for the diversified portfolio. But I do want to just dig into one little piece of this, Apollo. These 7 stocks are considered kind of growth stocks. They're very profitable stocks, but they're very growth oriented. The market is backing them to be very successful into the future. But the only way that this result could have happened, where the rest of the S&P 500 was flat, was where other types of companies have actually done pretty well. And one of the things that we talk about a lot with clients, and everyone thinks, and most people think index fund investing is fantastic, and we think it is for a lot of people. But the way we invest, which is to, look at the portfolio a little bit differently. You want to own a broad portfolio of stocks at very low cost, tick. But there are other dimensions of return that are really important. So the idea that you're buying lower priced stocks, value stocks, the idea that you're buying some smaller stocks grow to become big stocks, but also the exposure to profitability. Can you just talk us through how those different factors have contributed to the performance of people's portfolios over the last sort of 90 days, the last quarter?
Yeah, and this is really important because, as you said, and I think we kind of touched on this. If you look at investing today, and let's just take one market, you can look at Australia, you can look at the U.S., and I'll use the U.S. just because I'm more familiar with those numbers. You can think of the market as being this a square where all the stocks fits in this particular square. And then how do you delineate among them? How do you organize and separate them? Because certainly not all the stocks are the same is crucial. And this is where academic science came along in the late 70s, early 80s that pointed out to exactly to your point, David, is that if you look at these large companies that are part of the S&P 500, they're some of the largest, most mature companies that you can find. They have a great track record and a good operating history. Those are part of the market. And if I were to kind of think of a poster child for them, it would be McDonald's. It's been around for a long time all over the world. It's a fantastic company. Great. That is the poster child, in my opinion, for S&P 500. Now, in the US market, in the Australian market, there are companies that still trade, but they're not large enough to be included in that club of the S&P 500. And in the US, the example that I typically think of is another burger chain that is called Shake Shack. And Shake Shack, as opposed to McDonald's, it's still publicly traded. It's still a public company, but it is not as large as McDonald's. I'm not sure how many Shake Shacks are in New Zealand, Australia, but it is a pretty well-established burger chain, not nearly as big as McDonald's. And that is part of the market in the US. So if you think about these two companies almost intuitively, their risk return potential is different because these larger companies are more mature. They have a longer track record. So they seem less uncertain. On the other hand, if you think about which one of these companies can grow and let's say double in size, well, most people would say, well, it's probably easier for Shake Shack, the smaller company. And you can see that in the data. If you had looked at the S&P 500 over the long run, and there's a book that we have that certainly is available to Australian investors as well, that's called the Matrix book. And the Matrix book has a lot of data, a lot of incredibly powerful data. And it's there's a US version, the Australian version, and I'm going to use the US version again because I'm familiar with the numbers. $1 over about 100 years of data since the 20s would have grown in the S&P 500 roughly at about 14,000 fold increase. So $1 increased 14,000 fold pretty much in my dad's lifetime. And what's remarkable is that if you had invested the same dollar, not in these large, well-established, but the smaller companies, and these would be the Shake Shacks of the world, again, the smaller companies. If you look at the dimensional small cap index in that book in US dollars, it would be roughly about $54,000 in growth. So a significant what's called premium, which is a growth difference between large and small. And in the 1980s, the question was, what about all the large and what about all the small? And that's when the distinction came along that you also have to pay attention to how much are you paying to own something? What's the price relative to some accounting fundamental? The easiest one to think of is earnings. Given the company's earnings today, what is the price that I pay? But the way, you can also be more sophisticated and think of another term called book value, which is how much does it cost you to buy a dollar of assets from that company after liabilities are paid. And the lower cost companies are called value stocks. And over the long run, they outperform the more expensive counterparts called growth. So as an investor now, you know that not only that small outperforms large, but also value beats growth. So knowing that value beats growth and small beats large, the one part of the market that ought to give investors the biggest bang for the buck is small and value. And again, if you look in the Matrix book at this dimensional small cap value index, the same dollar would have grown through the end of 2024 at about 166,000 US dollars. So what this has given investors is a primer, not just for the US, but around the world. If you look at the market, pay attention to the entire stock market, not just the large ones that might be on the news. And then if you are purposeful in emphasizing more small companies and value stocks, as an investor, you give your chance to earn a higher expected return, a higher payout on your money. And to me, I think this is absolutely crucial because you can increase your expected returns without having to pick stocks, without speculating, but being very strategic and systematic. And that has been a really amazing primers that particularly institutional investors have been using for quite a while now, and now it's permeating more and more into the retail market. Later on, there was another distinction that was made, which is not just large, small value growth, but another distinction that has to do with the profitability of the company. And what research found is that companies that by and large are profitable, they continue to stay profitable, and companies that are unprofitable, they continue to stay unprofitable. And you certainly have to define where profitability is. And in that respect, you can have a higher expected return by emphasizing more, not just small in value, but also companies with a higher profitability. So now, if you think of an elevator, you used to have one cable, which is small versus large. Then you add another cable, which is value versus growth. Now you're adding a third one. And basically the main benefit of adding these more is that if one of them happens not to be present any one year, the other ones will hopefully hold you up. So that's sort of the idea that led to this improvement, and what we think of as index beaters. These funds that are designed to beat the index without picking stocks, without speculating, but by being very systematic in the way that we reshuffle the market deck and emphasize different parts of the market. Now, with that, David, I couldn't just do this without really kind of touching on what's the catch, because somebody just say, great. I mean, it seems like it's too good to be true. What's the catch here? And the primary catch here, it doesn't have to do with the numbers. The numbers are perfectly fine, but the same with everything in life. This is not about certainties and guarantees. There's no certainty or guarantee. We're talking about going swimming. That doesn't guarantee me a longer lasting, healthier life. In fact, probably if I swim enough, shark would get me. But the point is that you look at the odds. You always try to play the odds and put the odds in your favor. So in that respect, if you look, for example, at value beating growth, what you see is that over 1 year, roughly about 59% of the time, you see that result. And it doesn't happen every single year. About 4 in 10 years, you're going to see growth beating value. If you look at 5 years, that it's about 70%. So if you had a 5-year horizon, 70% of the time you'll see that value beating growth. But again, it's not trivial. 30% it's not there. And even if you have 5 years and you ask, well, which one would you like to emphasize? The one that gives you 70% odds or 30% odds? Value still is the one to go. But remember, there are going to be stretches of time, even 10 years. You look at 10 years, it's about 77%, and 20 years and 15 years is 86. So the more time you give these premiums to work for you, these differences, that the more likely it is that you will find those in your favor. But it's not a guarantee, and you have to give the system time to work. And that's why working with an advisor is such an important part of success using this particular strategy.
I'm really glad that you mentioned the whole time horizons part there, Apollo, because it's so important. But I think it's also important that when to give value a bit of a pat on the back when it has shown that it's outperformed. I'm not sure if you've got the figures on hand, but it has been a really, really strong quarter for the value premium. And I think it probably relates a lot to that point you mentioned before. Everyone looks at the big headline figure, which is -4% for the market. But when you actually take the time to look a bit further under the hood, what do the figures look like if you actually look at value stocks?
Well, for example, in the US, when you look at large value, when the market as a whole was down about 4.3%, large value was up about 2%, 2 to 4%, depending on how you measure it. You look at small value is up about 5%. So in a market, when you see all this, bloodbath, like, oh, things are going down, they're not going on true, but it's still like a 4% loss over a quarter is not pleasant in the S&P. There are parts of the market, for example, in the US, like small, like value, that actually had positive outcomes, positive returns, which is really, really impressive that they're paying off at a time when it seems like, there's nothing really working. Well, there are absolutely parts of the market working. And this particular quarter, as well as last year, you saw that value and small really did quite well.
Yeah, and I think if we look at the Australian market, this is a really important thing. It's easy to focus on that -4% for the quarter. But if I look at this, for the Australian market, at the end of March, the Australian market was sitting at around 11.59% for the full year to the end of March. So even though people have had a negative quarter, they've had a really, really strong year. And this is such an important anchor we need to keep bringing people back to if they want to be successful investors. Okay, so let's just call this. If you want to be a speculator, that's fine. You can jump in and out of the market. You can do all sorts of stuff. You do what you need to do to get your jollies, I guess. But if you actually want to make money, if you really want to be a successful investor, you have to follow the rules, right? Which is really be disciplined, have an investment philosophy, understand that you're playing the long game. But if you look at the whole of the Australian market, at least the top 300 stocks in the Australian market, that's 11.59 for the year ended March. Do you know what the value component of that is? 27%. So that's a massive outperformance. And all you had to do was show up. The small company outperformance was 13%. So several percentage points better than the largest companies in the market. So this is just a reminder for our viewers and our listeners, particularly those who are new to the podcast that aren't our clients, is that so much of the financial industry creates mystique around what you have to do to be successful. Actually, what you have to do is have a really sound investment philosophy, and you have to show up, and you have to show up and stay there. And that's what brings you the real success over a long period of time, right?
And David, to that point, it's so misleading in a way to cite statistics. And I looked at, there are all kinds of international small value that have done incredibly well over the past year. You have Australian value, all these numbers. The trick is that you had to have them in your portfolio before these great results, not after. So, a well-diversified, well-put-together allocation would not necessarily missed out on these. And I think that's really important that these numbers are not just like in the rearview mirror, but that you had that piece, that allocation in your portfolio in a thoughtful way without placing big bets, to your point. So it's crucial that not just, looking at this is an abstract. a well-constructed allocation would have had the discipline to hold these investments at a time that perhaps they didn't look great, because out of nowhere, boom, here comes the great result, and you had to be there for that.
Yeah, and I think that's true, particularly over the last 5 years where the Magnificent Seven, certainly in the US, have been the main game. If you did not have an exposure to the Magnificent Seven, then you would underperform in your portfolio. But what we always find endlessly fascinating, Apollo, is that our portfolios are naturally underweight the Magnificent Seven. They have to be, right? Because we tilt our portfolios towards value, towards small. And yet our portfolios rarely suffer for that fact. You know, during the tough times, they perform broadly in line with the index. But when value and small perform well, they kick along and perform better than the index. So I'm not calling this a free lunch ever. There's no such thing as a free lunch in investing, but it's a really interesting dynamic that by diversifying your portfolio in a super smart way, you can achieve really quite amazing results.
What's the saying? You're not going to make a killing, but you're not going to be killed.
Totally.
Yeah.
That's so true.
What I would also like to touch on, Apollo, I'm not sure if this maybe relates to some of the conversations you're having with the family, but particularly when you're looking in markets, and it always seems like we're forward looking, we're looking at the next thing to be concerned about. But if you actually look back about a year ago, or just over a year ago, was right when President Trump came out with the tariff board holding it up. And the market fell significantly in the middle of April last year, the broader market. And so what I've been doing a little bit with clients is almost just showing the 1 year return a year from that date, and saying it's very easy to cherry pick data, because the difference between looking at the very bottom, which was only a year ago from when the tariffs came out, so the recovery is sometimes been about 7 to 8%, just looking at a 3-week difference. So I guess my question to you, Apollo, is it still feels like there's lots of uncertainty in the world. There's not necessarily been any resolutions from what's been going on. So what was some of your, I guess, comfort or wisdom you said to that family who might still be feeling very uncertain?
Yeah, and I think that what I wanted to reiterate to them is that the emotions that they feel, they're absolutely legitimate, and they're anxious about the family member. They're anxious about seeing the world. There was an element of politics involved in it, and I do have to say that those are legitimate. That's what makes us human. And the perspective that I wanted to kind of give them is that when they are putting the money to work in the stock market, they're not really gambling it. They're not really putting it into a casino, but rather what they're doing is that they are buying ownership in companies, into businesses that allow them to get ownership in that business. And these are companies like Facebook, like Coca-Cola, like Newmont Mining, like, you have all the banks in Australia, you have Toyota, you have all these companies around the world that have opened up the ownership. So what I try to frame to them is that when a situation like this happens, what the question that the market is asking is not about the morality of the event, but rather more pragmatically, how is this impacting the potential for different companies to operate and make money? And that is the legitimate question, because if you are a business owner and you want to sell your share, you want to make sure that you get paid, you get compensated for that share of ownership, and you don't get underpaid. If you want to buy, you'll make sure that you don't overpay. So that's what the function of the market is. And in that respect, when this event happened and we had the war, what you saw is U.S. airlines, for example, that had flights in the Middle East. Well, they dropped in value because their operations were disrupted. At the same time, contractors, contracting companies for defense, they went up in value because there's likely there are going to be more orders. So the impact for each company is what the market assesses. But what I also told them that I think it was quite interesting is that from my experience, and when we look at the data and when we look at what happened in the past, what is absolutely fascinating is that when there is a challenge to which people are confronted, or companies, or the markets, or an entire economy, what we see over and over is a resilience and genuine innovation. That's human creativity kicks in and looks at the challenge and say, how do we move beyond that? How do we get past it, rather than just say, well, we're shutting everything down, we're done, because now we have a challenge. So for example, oil. When you look at oil right now, a lot of folks are saying, well, this is bad. The price of gasoline is high and petrol in Australia, I know we got higher. I think that's the bad news. And it's certainly bad because some people would likely be impacted more than others. But I also find interesting is that there are times when petrol price didn't go up. And if you look at the crisis of 1973, 74 in the US, when the OPEC countries decided not to ship oil to the US, you had a situation where the government decided that they want to protect people and they did not let the market prices adjust. And this is one of the biggest things that we believe in is markets and prices. And if you look in those days, the price of gasoline in the US is about 40 cents a gallon, which is about 3.6 liters. And the government said, well, after this crisis, the most that a gas station can charge is 50 cents. So they only moved it up by 10 cents. But by not letting markets, supply and demand work, and making prices a rationing mechanism, because that's a huge function. What you had are low prices, but you also had shortages. You had lines and lines of cars waiting at gas stations that had no petrol. And that was because, again, there was no mechanism as in the price to ration. And what came out of that, which I think is a really interesting element, is that there was a realization that maybe these cars that we drive, they're not the most fuel efficient. So let's make others. Let's make more fuel efficient cars. There was a highway speed to make sure that we have some fuel economy. But I think the most important element is that back in those days, the US produced no oil, pretty much no oil. And those two words, energy independence, were spoken for the first time. And over the next 50 years, the US, based on that challenge, now became energy independent. And in fact, it is a net exporter of oil. So to me, whenever something like this happened, rather than go and be negative about, oh, this is so bad, at the moment, it doesn't look pretty. But the fact that the markets are allowed to work and the fact that we see over and over that human ingenuity, creativity builds resilience, and that resilience is going to permeate from the individual to the company, to the market, to the society and the country at large. That's something that we see over and over and over again. The pandemic was another example. So to me, when I look at this particular situation, both for Australia and the US, it might not feel great at the moment, the same way that those people at the pump didn't feel great. It's just that down the road, I do believe that it's going to make companies, the markets, and the economy stronger.
And that is such a wise reflection. And in amongst that, it's very useful, I think, to remind our viewers, listeners, about the role of the media in this, because there is a lot of catastrophizing going on at the moment. There just is. And I think that flows through into market prices. You know, I'm just looking at my screen here earlier, and I was looking at some of the Australian stocks that our listeners will be very familiar with. Woodside Energy is up 52.6% this year. Santos is up 31.7% this year. They're very good value companies and they're highly profitable. You know, I just wonder, has the intrinsic value of those companies changed that much in the last 12 months? Maybe it has, maybe it hasn't. But the reality is there's so much catastrophizing going on in the media that it's very hard for us to keep our heads cool.
Yep.
And, you know, I'm just interested in your thoughts on that.
Oh, I mean, absolutely. And I think you're absolutely right. It is, and again, I'm not here, everybody's piling on the media. To some degree, I think it is upon us, the consumers of the media, not to confuse entertainment with advice. Media has never kind of said there, I'm here to give you financial advice. They're never there to tell you that. They're also all big disclaimers, entertainment purposes only. That's where their job is. And it's sometimes very bad entertainment, but it's nevertheless entertainment. And it's upon us to realize that hey, there's a distinction between entertainment and advice. And if you are trying to sell entertainment, and particularly the financial media, they're catastrophizing, in my opinion, because there are two fundamental emotions that drive humans. One is fear and the other one is greed. And it turns out that fear is something that fundamentally saved our species, because if you go back in the early days and you get chased by an animal, you're afraid, you run, and that saves your life. And I think that's what really the media is trying to do, is try to trigger these emotions so you keep watching. And they've gotten really good at that. They've gotten really, really good, not just social media, but media in general. And if you go now on social media, they know you. They know that, hey, I'm going to feed you exactly what you want to hear. And that reinforces your views. So if you have a negative view, it's going to get reinforced over and over and over again because the algorithm is built that way. So you got to be so careful with your media consumption and make sure that to some degree you understand the distinction between entertainment and advice. Also understand that their business is to sell ads, and the way they sell ads is by keeping you locked into their program, and the way they do that is by tapping into your emotions. And it's been going on for a long time, but I think it's what makes it harder today is that we are glued to our phones much more so than we were glued in the past to our TVs.
Yeah, exactly. And what it strikes me with your little example there of talking about the caveman running away from the saber-toothed tiger to save his own life, the fear, the fight-flight response. At the core of the human condition is to survive and then thrive. And those that anatomy, if I can call it that evolution actually undermines us being successful investors, because the survival instinct is I have to run away from this perceived danger. I must run away from this perceived danger. But the truth is that to be a successful investor, to thrive as an investor, you actually have to suppress that urge.
Yep.
Apollo, I wouldn't mind just delving to a little bit of a different topic at the moment. So there's some big listings that are coming onto the share market,
True.
particularly in the AI space. And anyone who's got a phone or has picked up a newspaper has been reading about artificial intelligence, the move towards that. And I think a lot of people are thinking, well, how do I get a bit of that pie? How can I pick the next Apple, the next Microsoft?
Also SpaceX, that's going to be the biggest, I think that's going to be the biggest listing in history, right? Like $1 trillion. It's just huge. Like, how do you, FOMO?
Yeah.
Tell us about FOMO when it comes to those big listings. AI, Claude, SpaceX. What's going on in people's heads?
So there are some very big listings. So let's just demystify a little bit. First of all, what does it mean to be listed? What's this whole thing all about? If you are thinking about deploying your money in the market, I think we talked about it when I was in Perth. There are three basic options that you have as an investor with your money. I mean, if ideally you'd have a financial plan that distinguishes and kind of allocates to these different branches. But one of the branches is buying ownership in companies. And the second one is about lending money. And the third one is investing in non-economic activity investments. And that could be collectibles, that could be other things that don't have an economic activity, but they can still make you money. So let's focus now on this idea of ownership, which is associated with equity and the markets and so forth. So what does ownership basically mean? Ownership has two different branches here. One branch is called private equity. And what private equity fundamentally means is that the company is controlled by the founders or a group of people that they control it, and they don't have to tell the world much because it's a private company and you can be private. And they let in whoever other owners they decide they want to let in, whether it's the employees who buy into the company, or whether it's other friends or family, or whoever else they want to bring in. But they have a latitude to choose who they bring in. And there's a second type of ownership that you can buy as an investor, which is public stocks. And what it means is that some companies transition from being private at some point that they just a few folks control them, a group of people self-selected control them, to now opening up the ownership to the public at large. And that's exactly what's happening right now with companies like SpaceX, Anthropic, or Chat or OpenAI. These companies are right now private, meaning that they are controlled by the owners, the founders, and they are the ones who basically decide who they let in. And now they're in the process of saying, well, we want to open up the public, the ownership to the public at large. And because these are so well-known companies and the founders are well-known, I think a lot of people are looking and saying, I want to jump over this opportunity because this is amazing, these companies. And to me, there are some cautionary tales. The first cautionary tale is that this company might have been a phenomenal deal, whether it's SpaceX or Anthropic or OpenAI, at a time when it was really small and unknown. But the better known the company got, the more access they had to capital, the more it increased its value. So by the time you buy into it right now, it might not be a good deal because they know what their worth is. So you might be paying through the nose, and it might be a good deal or not a good deal. So you got to be super careful now if you want to participate in this stage to say, I want to buy it now. In other words, this would have been an amazing thing if you had known Elon Musk and you talked to him way back when he started SpaceX. That would have been a great time. But over time, as there were multiple rounds of financing, the true value of the company to some degree was established. So that's the first thing that you have to really consider. The second thing to consider when you want to participate in the ownership of these companies is to realize that in the beginning, only a handful of these shares that the private holders have will become available. And I don't know exactly at the moment what it will be for SpaceX, but I think that just from my understanding, if you look at this pie of ownership, what's going to happen initially when SpaceX actually releases some of these shares for public ownership, it's going to be a fraction, let's say about 10% or so of the shares in the company that are available to investors in the public market. So what this is saying is that if you are now wanting to participate, you're going to basically have to fight with a lot of other people because only 10% will be initially available. So what they're trying to do in some ways is create this frenzy that, hey, you need to go get those shares, and everybody's going to fight and climb over each other's shoulders to get the shares, but only about 10% will be available. What about the rest of the 90%? Well, it turns out that, for example, in the case of Facebook, there was a period of about 6 months when these insiders were not allowed to trade. But at the end of the 6 months, it's quite possible that these 90% can just feel free to go sell whatever they want to sell. So if you rush and you try to get this particular company right now in this stage when only a limited number of their shares is available, perhaps just to kind of really create that frenzy, the feeding frenzy, you got to be careful because, listen, this company is still going to be around, and it's quite possible that 6 months from now, some of the other 90% are going to start selling. And at that point, you're going to have another huge supply of shares being available. And that's exactly what happened with other IPOs in the past. Which is the process that we're going through. It's called initial public offering. And when that happens, you might find yourself basically, this is not worth as much because now there's so many more insiders who want to sell. And because of that, one of the things that we've suggested and we have executed in our funds is that we want to flush out some of these insiders. We don't be the ones jumping there at the first minute that we want to own SpaceX, because it's possible that if in a few months you have these insiders putting more and more shares on the market, and this was an artificially low number just to create that frenzy, you are better off waiting. So what we've done in our funds is basically have a process where we kind of wait about a year to flush out all of this, and then you can come and participate because that company is not going anywhere. And hopefully you shouldn't own a company just for the next few months. So I don't know there's a great benefit to owning it right away as opposed to waiting after they go public, wait a period of time, let this flush out, and then come back. But it's always interesting how people get carried away. I want a piece of that, and it might be fear of missing out, as you said, FOMO. But that comes at a high price because I do see that Elon Musk, for example, just from what's being published out there, he's pushing for some major changes to indices in terms of what they allow, and it's remarkable how everybody's trying to bend over, but ultimately, the smartest money is going to be the way in kind of taking a step back and say, let me see how this plays out and not jump in that feeding frenzy because it might not be in your best interest.
Yeah. In another episode, we'll talk a bit more about price discovery because that's what you're talking about. What's the real price of this? Not the inflated emotional, FOMO price. What's the real price? And price discovery takes time. And it takes a lot of information. It takes a lot of transactions for it to find its equilibrium.
And their market, they're just the way that the market operates. You have to be aware of that because markets are not perfect. I mean, there are different trading scenarios in which you might want to have the experience to know when to trade and how to trade. And even as the market's doing these price discoveries, there's certain elements of the market that you need to pay attention to when it comes to trading.
And I think just to round that out as well, Apollo, I know I've heard, I think it was you or a few members of your team say flexibility is such an important part of being able to turn up to the market. You don't want to rock up with a gun to your head saying, we have to buy this allotment, and you're almost sort of getting the price you get. So I think it's, as you alluded to, Dave, we'll talk a little bit about more of the granular of that in another episode, but it's such an important part of being able to participate in the market. So I think that'll close us out for today's episode. We've covered a lot of content. There's been a lot going on in the world in financial markets. And what I really appreciated today, Apollo, is we're able to look a little bit deeper than the surface headline, the surface numbers, and actually get a bit of an understanding of the why behind what's going on, and also to give our listeners a bit of an understanding of where the returns have showed up in different parts of the market and why it's so important to have really good portfolio hygiene and a really clear investment philosophy.
Yeah, and I think if you're an investor out there that's not working with us, if you're looking at making big decisions, ask yourself the question, do I have a clear investment philosophy with rules in terms of how I'm going to engage the market? If you can't say yes to that, chances are you're going to make some pretty expensive learning mistakes along the way. So having an investment philosophy, having rules of engagement, the way you're going to go about entering the market, sticking in the market, the way you're going to think about in advance, the way you're going to behave when things get rocky. There's a saying, markets are a tough place to learn life's lessons.
Absolutely. Apollo, thank you so much for joining us from the other side of the world in California. It's probably getting late on your time, but really appreciate you joining in and sharing all your wisdom and expertise with our listeners.
It's been great fun and a privilege. Thank you so much for the invitation.
Thanks, Apollo.
And as our listeners know, we love it when you share the podcast with a friend, someone in your network, someone in your community. Make sure that you subscribe to our YouTube channel, follow the podcast, and we love it when you send through any different topics, content, or insights that you'd like us to explore on the podcast. Thanks for joining us. Thank you for listening to another episode of the Purposeful Investor podcast. Make sure that you share it with a friend or someone in your network who you think would benefit from having a listen. Both David Andrew and myself, Aden Wilkins, are authorised representatives of Capital Partners Consulting Proprietary Limited, and we operate under the Australian Financial Services Licence 227148.